Let's talk about a business that, on the surface, seems about as boring as it gets, a network of metal warehouses. But what if I told you that this boring business is actually a high-margin machine with a ridiculously powerful competitive advantage, what investors like to call a moat?
So, that's the big question we're tackling today. How on earth does a company in a notoriously tough, cyclical industry like steel manage to build a durable billion-dollar moat? All right, first things first, we've got to bust a huge myth about this business. We really need to separate what people think it is from what it actually is.
You see, the myth is that Reliance is just a simple middleman, buying metal cheap and selling it for a little bit more. But the reality? Oh, it's so much cooler than that. They've become a deeply integrated, high-margin partner to manufacturers all across the country.
So, what exactly is Reliance Inc? Well, they're the biggest player in the game, the largest operator of metal service centers in all of North America. They're a really critical piece of the supply chain for more than 125,000 different customers. And what they're really doing is solving one huge fundamental problem of scale. Giant steel mills, they're built to pump out insane amounts of metal. They just can't deal with selling a few steel bars to a local machine shop. It's not efficient. And that's exactly where Reliance comes in. Honestly, the best way to think about them is as the 7-Eleven of metal. It's a perfect analogy. They're the convenience stop that bridges that massive gap between the giant mills and the thousands of smaller makers who actually use the stuff. So here's how it works, right? On one side, you've got the giant mills. They need massive orders and have really long lead times. In the middle, you have Reliance. They step in, buy an enormous bulk, hold all that inventory, and, this is key, they process it. So for the customer on the other end, it means they can get exactly what they need in tiny quantities and get it delivered super fast. And when we say small orders, we mean it. The average order size for Reliance, it's just around $3,000. They are built for precision and small batch service, not for slinging giant commodity loads. And the speed? Get this. A whopping 40% of their orders, they're out the door in less than 24 hours. That is unbelievably fast in the industrial world. It's a total game changer. So you can see how this all comes together, right? With over 100,000 different products ready to go, they offer speed and availability that nobody can match. This lets their customers just outsource all their inventory headaches, saving them a ton of money, and making Reliance the ultimate one-stop shop for metal. But here's the thing. Just being a super convenient warehouse, that's not the whole story. Not even close. Their real competitive advantage, their real moat, is what we're going to call the value-added moat. This is how they truly make their money. So what is this secret weapon? It's not just about having the metal. It's about what they do to the metal before it leaves their warehouse. It all comes down to one phrase, value-added processing. Okay, what does that actually mean? It means they don't just sell you a big sheet of steel. They take that raw metal and transform it into a semi-finished part that a customer can just grab and plug directly into their own assembly line. And we're not talking about just simple cuts. No way. This is high-tech stuff. We're talking about laser cutting complex shapes with incredible precision, slitting massive coils of steel into perfect strips, machining and drilling, and even putting together entire kits of parts ready for assembly. And here it is. This is the number that changes everything. Today, over half, 51%, of all their orders have this kind of high-value processing baked right in. That's a huge shift from how this industry used to work. So why is that such a big deal? Because it creates powerful switching costs. Think about it. When Reliance is cutting a custom part that fits perfectly into your production process, they stop being some generic supplier you can swap out to save a few pennies. No, they've become a critical part of your manufacturing process. And if you want proof, hard evidence that this strategy is working, just look at their gross profit margins. It's right there in the numbers. Historically, they were stuck in that 25 to 27% range. Now, with this big push into value-added services, they've structurally lifted their margins to a whole new level, consistently hitting 29 to 31%. That's a massive and permanent improvement. Okay, so we've got this amazing, profitable machine. Now let's look at what they do with all that cash it's spitting out. This is where they become what some people call a capital-smart cannibal. Just look at their capital plan for 2024. It's kind of mind-blowing. A massive 76% of their cash from operations went straight to buying back their own stock. And when you add it all up, They actually spent more than the cash they brought in by using their super strong balance sheet. It's an incredibly aggressive way to return capital to shareholders.
To put a dollar amount on that, we're talking over $1 billion, 1.09 billion to be exact, in just 1 year, on buybacks alone. It's a really simple but incredibly powerful idea. Instead of just trying to make the whole pie bigger, they're also shrinking the number of slices. And what does that do? It makes every single slice that's left that much bigger, that much more valuable for shareholders. And they're not just shrinking the slice count. They're also growing the whole pie through really smart, disciplined acquisitions. They're kind of like the Pac-Man of their industry, gobbling up over 76 companies since they went public, and they're still at it with more smart deals just this year. So look, we've pretty clearly established that Reliance is a fantastic, world-class business. But that brings us to the final and maybe the most important question. Is a great business always a great investment? And the data here really tells the whole story. You can see, when you stack them up against their competitors, Reliance is just better. Higher margins, way less debt. But, and this is a big but, the market gets it. Everyone knows they're the best, which is why the stock trades at a premium. You have to pay up for this kind of quality. And that perfectly sets up the two sides of the coin here. The bull case is, hey, this is an incredible industrial compounding machine, and it has absolutely earned that premium price tag. But the bear case says, yeah, it's a great business, but that price is so high that there's just no room for error if the economy takes a hit. And that's really what it all boils down to. You've got a world-class business, no doubt about it. The multi-billion-dollar question for any investor is whether it's also trading at a world-class price.